All right, let's take a look now, a closer look at the markets with Jeffrey Kleintop. He is the Chief Global Investment Strategist over at Schwab. Good to see you, Jeffrey. Always nice to have you on the program. What do you make of the market behavior this week as we see the number of COVID-19 cases continuing to surge in pockets of the country? Where are our investors' heads at the moment?
Well, obviously, it's a balance between the economic recovery that's in place, and certainly the data we've been getting has been very solid, combined with concerns about fears about what lies ahead and the rising number of cases. Fortunately, we haven't seen as much of an uptick in new deaths. What I've noticed is that the stock market seems to be tracking the deaths more than the case data, and those continue to remain fairly contained, although maybe ticked up a little bit in recent days, still way down from their peak back in April, unlike cases, which have surged since then. So that's an encouraging sign and one that's echoed around the world.
Jeff, give me some positive catalysts for the market as we look towards July. I don't see many on the horizon. To me, a lot of those positives have been baked in May and June, but what do you see?
Yeah, I got to agree with you there. I think some of the positives could be maybe tied to a shift in how the bond market is perceiving some of this data. You know, we've seen a big move in the stock market, but the 10-year yield is what, 65, 66 basis points? I mean, still pinned to the lows. I know there's some thoughts that the Fed might engage in some, yield curve shaping, but it seems low relative to what the stock market is pricing in terms of a recovery. We don't think the yields stay there. We think they're higher as we head towards year end. And so that could mean some momentum to sectors that actually benefit from higher yields, like the financial sector, which is a laggard today.
What do you make of the pullback we're seeing in financials, given the results of those stress tests? I mean, yes, the Fed did cap the dividends. They didn't take away the dividends. They're capping the buybacks. They didn't take away the buybacks. And by and large, the banks, came out swimmingly following those stress tests. So why this pullback that we're seeing today, you think?
Short term, I think we know buybacks have been a powerful force lifting stocks in recent years. So knowing that they're out of the equation for a while, is a bit of a blow, perhaps to near-term momentum to the market. But we actually like financials. It's a sector we recently upgraded in the last week or so to an overweight. Obviously, the weakest sector today, but it's not been that bad this week. I think as bond yields rise later this year, maybe a steeper yield curve will help. And it's one of those sectors that's sort of interesting. It's kind of an in-between as it relates to economic growth. It's not a sector that thrives on a V-shaped economic recovery like the energy or materials sectors that have been great performers off the lows. Likewise, it's not going to do well if we head back to recession. That's utilities. It's one of those in-between sectors where more modest economic growth, as we see this V-shaped recovery maybe flatten out a little bit, could do fairly well in that environment. That's an environment that we see as most likely here in the second half of the year.
Jared, over to you. Hit us with some charts today.
I'm sorry?
There we go. No, I had to unmute myself.
It's Friday. It's all good, man. All good.
I was just looking at the energy sector based on Jeff's comments, and we're seeing some red right now. Crude oil is going to end down for the week, but it could have been worse. In fact, crude oil's had such a nice run. It's only been down 2 of the last, I believe, 9 weeks. Let's take a look at our NASDAQ 100 heat map. FANG names, kind of a mixed bag, although we do see most of them under pressure. Amazon bucking the trend, up about 0.8%. Facebook down 2.4%. And just sorting by performance, we see the big leaders are NetApp, that is up 3.5%, followed by eBay, and then Broadcom, Dollar Tree, NetEase. Kind of an interesting mix here. To the downside, we talked about Facebook, that's the biggest loser. And then some travel names. United is down 1.6%. And just looking at our travel heat map, cruise lines, well, most of them in the red right now, but Carnival bucking the trend, they are up about 0.25%. And looking at the Dow, we see weakness in the financials, which we've been talking about. Goldman now off about 5%. Industrials also weak. Boeing's off about 2%. And then some of the winners, Home Depot's up 0.25%, along with Intel and Procter & Gamble. That safety staples play is up about 0.25%, Brian.
All right, Jared, I'll take it. Thank you. Jeffrey, we were talking a moment ago about catalysts for this market this summer. One I'm thinking about is trade, right? I mean, the U.S.-China trade situation is sort of percolating in the background as we continue to deal with surging cases of the virus. But how much are you considering that when you look at portfolios, and is it dictating how you see the market?
Trade is a big concern. Obviously, it can move the markets pretty significantly on any day. And if we were to see an eruption in that trade tension, meaning that the phase one trade deal would be gotten rid of, disposed of, that would be a grave concern. That doesn't appear to be the case. President Trump appears to be addressing and challenging China in other ways and leaving that trade deal on the table. So I feel like that's probably relatively intact. The U.S. versus the EU is a concern. Of course, as we look at the post-Brexit environment, the UK trying to work out a trade deal with the EU, those issues still linger. And you're right, could come up this summer as a potential hiccup for the markets.
Jeff, when you talk to clients right now, what's their number one concern?
It's really the virus. I mean, it's really about a second wave. And that's why I'm encouraging them to focus more on the deaths than the case count. We've seen the case count rise in a number of countries like Sweden. Sweden is certainly in the second wave of new cases, but the deaths in Sweden continue to steadily decline. I think that's what the market's going to be keying off of. But absolutely, that's their number one concern at the moment.
And what about these pandemic trades that we've all been talking about, the airlines? Actually, American Airlines today, a short while ago, coming out and saying it's going to stop capping seating capacity on planes beginning July 1. What do you see as the trade there for those stocks?
Well, it depends so much on local activity. It's interesting to see, maybe you could look at box office results or dining reservations as an example of how willing people are to be with each other in an enclosed space for an extended period of time. Now, we've seen dining reservations tick up in Australia, Germany, places that have really nailed COVID down. Other places, not so much. Dining reservations still remain fairly low. And box office results, they're doing pretty well in Asia, but nowhere in Europe and certainly not in the US. Most theaters aren't even back open again in the US. So I think that's going to be very localized. Maybe some Asian airline travel, they could loosen some of those restrictions, but I'd be surprised if in the US that proves to be successful.
All right, Jeffrey Kleintop over at Schwab. Always good to see you. Thanks so
for
much.
having me.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.